This August, gas prices in Europe reached a historical high of over €300 per megawatt hour, over 600% higher than historical averages in preceding years. However, in recent days, gas prices have fallen quite a lot. You can see here that the European futures price has fallen by around 70%. And this is very significant because lower gas prices will be very welcome to European economies. In fact, last week, gas price futures for next day delivery fell to below zero. This is because there was so much supply but no demand for next day use because of mild weather. Now this might seem slightly strange, but in a crisis of energy you could have zero gas prices. And indeed it is actually quite misleading, but it actually shows why gas prices are likely to be very volatile in the coming months, and these falls in gas prices, although welcome, may be reversed quite easily. The reason is that it's harder to store gas, and Europe has tried hard to build up its stocks, and in fact it's been so successful, many countries are now close to full capacity. Despite the fact that gas is actually quite cheap, there's nowhere to put it. And so that's why the price of gas for next day delivery has fallen very much, because there's no demand to buy it for the next day use. If you look at gas futures prices for middle of winter or next year, they're much higher because that's when there will be a supply crunch and demand will be much higher. Nevertheless, it's not just about mild weather. There are several factors that have helped to reduce gas prices. Firstly, Europe has been quite successful in reducing demand. Demand for gas from Europe has fallen by about 16% year on year, and this is because of efforts to switch to alternative energy sources such as industry using oil or electric power. Households have sought to reduce gas consumption by turning down the central heating, and governments have mandated certain laws about maximum temperatures in public buildings. And also just basic economics, that since gas prices have gone up, many people respond, like myself, or probably you as well, by using heating less. We become a lot more conscious of it. And although I'm in a t-shirt today, don't underestimate the fact that I haven't been turning the heating on hardly at all this year, because I'm wanting to save as much money as possible. So this reduction in demand has definitely helped keep prices low. Secondly, there's been a big increase in imports of liquid natural gas. So that's risen by nearly 50% year on year. And you can see here that as Russia has cut supply, it has been replaced by imports from other countries, in particular the United States. They now export a lot of LNG to Europe, and they're now a bigger supplier than Russia is. Also, there's potential growth from African countries such as Mozambique and Algeria. And the high price of gas we've seen this year is likely to stimulate more investment over the coming years. Now, I must add a big important caveat to these falling prices. It really reflects a lot of short-term pressures. Because we have a mild start to the winter, demand is much lower than usual. And because we can't store gas for a long time, the price has fallen. But if we get a cold winter in the middle of December and January, you're likely to see prices shoot up, because that's when we will notice the lack of Russian supply much more, and there'll be intense competition for these LNG exports. And there's only so much that we can replace the old Russian land pipelines with LNG imports, especially when there'll be great demand around the world. But another factor putting downward pressure on gas and oil prices is the fact that the global economy is slowing down. And it's kind of ironic in a way that by pushing up gas prices, Putin has been successful in a way in causing a European recession. The increase in European inflation from 2 to 10% happened almost overnight. Well, not overnight, but in a few months. As the ECB President Christine Lagarde said, for many years we were fighting deflation, and then suddenly inflation appeared. And how have the ECB responded to this inflation? Well, because they have an inflation target of 2%, they're increasing interest rates. But this is very likely to cause a recession. because households and business are being hit in two different directions. Firstly, they have higher energy prices, less disposable income, but now interest rates are going up as well. But with Europe going into recession, that will reduce demand, especially industrial demand, and that will put downward pressure on oil and gas prices. You can see here how in 2008, the last recession, how much oil prices fell. And this is why a few weeks ago OPEC tried to cut supply. They tried to introduce new quotas to push up prices, and this irritated a lot of people, especially in America, with midterm elections coming up. But the interesting thing is, the OPEC quota has been relatively unsuccessful, because in a global slowdown, the big pressure is falling demand, putting downward pressure on prices. There is both good news and bad news on gas prices. There are some factors pushing down prices, such as the new supply coming online, the efforts to diversify to other energy sources, and the fall in demand from households and firms as they respond to higher prices and try to deal with a crisis. However, although prices have fallen quite a lot in the past few months, it would be a mistake to feel that it's all over. Far from it, because industry analysts expect gas prices to remain elevated for several years, because it will be very hard to replace the quantity of gas we used to import from Russia with LNG. It takes a long time for investing in new gas fields to come online and lead to increased global supply. Nevertheless, the fact that gas prices have come down from their August levels will be very welcome news for European consumers, firms and governments, because with governments introducing very generous price guarantees, obviously a fall in price will reduce the amount they have to pay, and it will reduce the burden on government borrowing and future tax rises. What about Russia? Well, from an economic point of view, Russia is getting the worst of both worlds. They've cut back on supply to their biggest consumer, Europe, but now they aren't getting the high prices they hoped for. They're still above pre-crisis levels, but it's not as high as they perhaps hoped. Now, of course, as we say earlier, this fall in prices may just be temporary, and prices are likely to go back up in winter. Nevertheless, it shows the weakness of this economic strategy, of irritating your major consumer so they never want to trade with you again, but also how there's a limit to how we can manipulate market prices. Because the irony is that by causing an economic slowdown, prices of oil and gas are coming down, and that will hit Russian oil revenues, export revenues and government finances, because 50% of Russian exports come from fossil fuels. Gas is around 13%, oil around 37%. So an important constituent of the export revenue for the economy and tax revenue for the government. Now combine this with other problems facing the Russian economy, such as a loss of the workforce as men flee the country or are conscripted into the army. Also, Russian industry is struggling to diversify away from fossil fuels because of Western sanctions, limiting the amount of components that can be imported, and also limiting the amount of export markets because of the reduced demand for Russian exports. So, although it is likely that gas prices will go back up in winter, it will only provide a temporary fillip to the Russian economy, which will still have all these underlying issues of falling productivity, falling output, and it will no longer dominate the fossil fuel market like it did before. Recently, the International Energy Authority made that quite clear, that Russia's dominance as a major fossil fuel producer, they will likely never get back, because the world, and Europe especially, is seeking to find alternative sources. You can see here how much of European inflation is caused by rising energy prices. It's different to America. America do have some demand pull inflation from strong growth and high spending. But in Europe, it's almost entirely from higher energy prices. Food prices are rising too, but that itself is indirectly linked to energy prices. So the rise in European inflation very closely correlated to the rise in gas and electric prices. And if these come down, then it will enable inflation to come down and hopefully persuade the ECB to hold back on raising interest rates as we enter into a recession. By the way, I recently made a video about whether central banks are making a mistake in raising interest rates in a recession. If you want to go into more detail on that topic, I do recommend that video. Because I would like to stress one thing, that even if gas prices do fall temporarily, all the warning signs that the European economy is heading towards a recession, especially Germany, which has been so reliant on gas in its industrial production. And you can see here how business sentiment has fallen very dramatically because of all the bad news on gas prices and global uncertainty. Another thing in the long term that European economies will try to do is try to increase their capacity to store gas, because that's a big stumbling block. There's all this cheap gas at the moment. In fact, tankers have been queuing up to deposit gas at European ports. The problem is that it's almost too much at once. And that's an important feature about gas, in that usually we've been used to what you might call just-in-time delivery. With fixed pipes running across continents, we don't need to store that much because we have this reliable source, and it's something we took for granted. It's like, water delivery. You use it when it comes in. That's how gas used to be. But with Russia cutting off its main Nord Stream pipelines, this is a very different scenario. And people say that in 2023, it will be even harder to replace Russian natural gas if they continue in restricting supplies to Europe. One possibility is that this winter, with high prices, Russia may actually open the taps a bit and try to export more, because they need the export revenue, they need the tax revenue. That might be a rational approach, although of course there's no guarantee that a rational policy would be chosen. I hope you've enjoyed this video. Please give it a thumbs up, and if you like the channel, please subscribe. There'll be lots more great videos coming out on economics soon. Thank you for watching. Bye.